Some days you just feel like a superhero, and today is one of those days because over the weekend we saved a client from getting screwed when another mortgage company tried to do some fuzzy mortgage math and convince him to pay an insurance premium to get a lower interest rate when that wasn't in his best interest. And I am going to show you exactly what the tactic was and exactly what the numbers say and whether or not it was a good idea or not to pay mortgage insurance in order to get a lower interest rate. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this very important video. And don't forget about our race to 25,000 subscribers, where when we hit 25,000, we're going to give away $5,000 to one lucky subscriber just for subscribing. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss how we saved our client this weekend from getting screwed. Basically, what I'm gonna do is I'm gonna lay out what we were suggesting for him versus what the other company was suggesting for him, why they were suggesting it, and what the numbers actually show when it comes to getting a lower interest rate and paying mortgage insurance in order to get that lower interest rate. And this is one of those things where, in the past, I've suggested to people that maybe they don't put 20% down. Maybe they only put 5 or 10 or 15% down in order to take advantage of still having some funds available for investments. If you want to know all about those suggestions, they're in my book, The Mortgage Millionaire, which you can get free right now. Just go to mortgagemillionaire.ca. I talk about basically the benefits of CMHC insurance versus not having it, and how you can use a little bit of insurance arbitrage in order to make a little bit more money. However, in this case, that wasn't what I discuss in my book. What the other mortgage company was suggesting was that in order to get a ridiculously low interest rate, the client put less money down, and as a result, end up paying an insurance premium that would get them a lower rate. Now, what were the rates? Okay, let's talk about that first and foremost. What we were suggesting for the client was they get a 5-year variable rate mortgage with all the features, all the bells and whistles, the best mortgage that you can get in Canada. That is typically what we sell. And that is kind of our go-to mortgage that we sell to clients and we suggest for clients. What the other company was suggesting was they were suggesting that the client get a 1.05% 5-year variable. And instead of putting a full 20% down, they suggested he only put 10% down and then use the extra money to put down as a lump sum payment after the mortgage closes. And they suggested that that would pretty much put him in the net same position as if he were to pay the higher interest rate and put more money down. And the reality of it is they looked at the numbers, they did the math, but they missed a couple of key components here. And that's what I'm going to show you today, because in reality, he wasn't going to be in almost the exact same position. He was going to be a few $1,000s worse off by having a lower interest rate. So yes, wrap your head around that. He was going to pay 1.05 instead of 1.45, and he was going to end up owing more and paying more for that mortgage over the life of it. So let's jump in here and let's take a look at this right now. And here is what I'm going to show you with respect to the mortgage math. By the way, everything I am showing you here is available on our DLC Mortgage Toolbox app. It's linked in the description below. If you want to run side-by-side comparisons, you can download that app and you can do exactly what I've done here. And all I did was I generated a report. I clicked email it and I emailed it to myself so that you could see it here. And basically, here's how the numbers played out. This guy was buying a $500,000 house. He was putting 20% down, which is $100,000. And the interest rate that he would get on a 20% down mortgage was 1.45% on a variable rate mortgage. You guys all know why we suggest variable rates. If you've been watching this channel for any amount of time, you understand that. If not, there's some really great videos in the last couple of months that explain why we're still pro variable. And basically what that ended up giving him was a $1,590 a month payment. Now, what the other company was suggesting was that he should put 10% down, pay the mortgage insurance premium, then put another 10% down after he takes possession of the property using his prepayment privileges, and ultimately pay the insurance premium, which will ultimately put him in almost exactly the same position. Now, I ran those numbers. You can see that I used 15% down, not 10% down, because the numbers worked better for him at 15% rather than 10% down. And ultimately, what ended up happening was this. If you go down and you take a look at the very bottom here, the balance at the end of the term was slightly higher with the 1.05% mortgage versus with the 1.45% mortgage. He saved a little bit of time because he used that one-time $25,000 prepayment to lower his mortgage amount. But at the end of the day, balance end of term seemed like it was about the same. Except for there's one thing that the guy who suggested this missed when it came time to actually run the numbers, and that was the difference in the payments. On the 1.05% option, with only 15% down, he ended up having a higher payment. Now, why is this? It's largely to do with the fact that he had almost a $12,000 insurance premium, therefore starting with a significantly bigger mortgage and ultimately ending up with a higher payment. So the payment at $1656 versus $1590 was about a $66 a month difference, which is about $4,000 over the first 5 years of this mortgage. So while it seemed like there was a big benefit here, or at least it seemed like he was getting a lower interest rate, the reality of it is the suggested get the lower interest rate, pay 1.05 versus 1.45 and pay the insurance premium actually ended up costing him about $5,000 more if the math was done right. But this is the key piece that the other guy missed, was that the payment would be pretty significantly higher if he were to get that lower interest rate. Now, this is where people get confused, they make mistakes because they take somebody's word for it and they go, oh, I'd rather have 1.05 than 1.45. It seems like there's a big difference there in the amount of the payments and everything else. And therefore, I want to chase that 1.05% interest rate, even though it's actually going to cost him more than it would on the 1.45. Now, basically, the conversation I had with this gentleman was I said to him, listen, I get where you're coming from. My guess is that they're just doing some funny mortgage math. They're moving numbers around. Let me actually do the math for you. My guess is that the 1.45 is probably still going to be a better deal. And lo and behold, it is to the tune of about $5,000. Because quite frankly, once he got behind by having that insurance premium up front, it's going to be very hard for him to catch up with a lower interest rate, even if it is 0.4% better. Now, there's a couple other things that the other guy missed here as well. First and foremost, what happens if interest rates start going up? Well, if interest rates start going up, then the problem becomes when you go to lock in, if you don't have that extra time, that full 5 years at the 0.4% difference, well, then you don't have enough time to make up the money and you end up losing even more as a result. So there's a whole bunch of things that were wrong with this idea. And, some people might suggest that, well, what if he went in and he increased the payments? We ran those numbers too. We made the payments the same, $1,656 either way. This is a different report that I ran. And if you take a look, if you make the payments the same, you end up in a scenario where he actually is significantly better off with the higher interest rate, the 1.45, which is on the right side here. And what ends up happening here is if you equalize the payment, you make his payment $66 higher on the 1.45% mortgage, you end up putting him in a position where he saves significantly more by paying a higher interest rate. So again, this is one of those things where people look at the interest rates, they don't understand it, they don't understand how interest rates work. It's not simple math, it's a little bit more complicated than that, and they chase that low interest rate, low interest rate, low interest rate, and they end up as a result paying more because they weren't able to do the calculations. So here is the moral of the story. Here's what I'm here to tell people. The information that I want to share today is really simple. If you're getting a mortgage, you need to find somebody that first and foremost you trust, somebody that you have vetted, and then trust them to make the recommendations to you that are in your best interest. Because here's what happened with this guy. He sought us out, we did his application, and then one of his friends said, hey, you got to go and call these other guys. He had no reason to call those guys other than his friend suggested it. And when he called them, they were a type of company that was significantly different than us. We're an advisory company. We just want people to make the right mortgage choices. The other company was a sales company. And when you run into sales companies and companies that don't take the advisory position seriously, what they do is they try to do things like make the numbers a little bit more fuzzy. They try to do things like move the numbers around and convince you that getting something like a 1.05% interest rate is a significantly better idea, even though you have to pay $10,000 in mortgage insurance than paying 1.45% and getting a significantly better deal. So we saved this guy, thank goodness. It makes for great content on YouTube because I get to tell you the story. And at the end of the day, like I said, if you even have that inkling, just the tiniest little inkling that you can't trust the person that you're dealing with, or the tiniest little inkling that they are selling you something that may not make sense because you don't necessarily understand it, or they just throw something completely out of left field like, hey, pay mortgage insurance and do this and do this and do this, and it doesn't seem like it makes sense. Make sure you reach out to somebody who can do the numbers, or try to do the numbers yourself, download the app, and make sure unequivocally that you are getting a better deal. And check everything. Check the amount of interest you pay, check the amount of principal you pay, check the difference in payments, because at the end of the day, well, this seemed like it was a good deal, and it seemed like it was great because he was getting us ultra low interest rate. At the end of the day, he wasn't getting a great deal. And it's like anything else in life, you get what you pay for. If somebody's selling you something for super, super cheap, there's a pretty good chance that the information and the recommendations you're getting are worth exactly what you're paying, which is not a heck of a lot. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next one. Cheers.